All right, so now in this section, I'll be talking about fair value gaps and how we can identify valid ones that we can actually play off of and understand where market is going to go based on these gaps in the market. Now, if you guys remembered from where we last took off, we last previously talking about these high time frame zones, these smaller, lower time frame zones. And another thing you guys can even enter off of is what I call fair value gaps. So this is a concept that you guys want to keep in mind as well when you're trading. But there's fair value gaps on every single time frame that you can imagine. Okay. Again, this depends whether you're swing or day trading, but in this case, we are day trading. Okay. So what fair value gaps are is they are gaps in the market that are representing efficient movements in the market. So anywhere in the market where you see efficient movements is an area that's potentially a gap. Remember when I was talking about these efficient moves up and down and gaps? Well, that's exactly what fair value gaps. They are gaps that are representing efficient moves in the market. So fair value gaps are extremely important to understand as this helps us identify efficient areas in the market that we can play into or off of. Now, what is a fair value gap? How do you identify what a fair value gap is? Well, a fair value gap requires 3 candles, okay? So in this instance, we're going to take the example right here. We have one candle number 1, candle number 2, and candle number 3, which is this bearish doji candle here. 3 candles, okay? For fair value gap, we have to have 3 candles. It's either 3 candles or just there's no fair value gap. It has to be exactly 3 candles. It can't be 2, it can't be 1, it can't be 4, it can't be 5. It has to be 2, or it has to be 3 exactly. All right. Now, what we want to do and see in a fair value gap is we want to see wicks on both sides of the inner and outer candle. So the inner candle will be the first candle, okay? The outer candle will be the second candle. Doesn't matter what time frame you're on. Second candle. Now, we want to be looking at these wicks and where they are on these outer candles that are protecting the inner candle, the inside candle, which is this gap. This right here is the gap candle, okay? The outside candles are these two right here, the first and third. Now we want to pay attention to where the wicks stop. So this is the wick, and this is also a wick. Now, how do you know this is a gap? Well, we know this is a gap because price always has to fill every single part of price. If price doesn't fill a part of price or a certain price range, it creates a gap. That's when price moves so fast, okay? The reason why these gaps occur is efficient areas in the market where price either is a really efficient area or price pushes extremely hard, whether going down or going up by institutions. When institutions push price extremely hard like this, it will leave a gap. So fair value gaps help us also identify very strong moves in the market. So once we identify the 2 wicks on both sides, we want to see, are these 2 wicks touching each other? Are they overlapping each other? Well, no, they're not. They're clearly not overlapping each other. They're pretty far away from each other compared to, the candle. So what this causes is a fair value gap right here. We can draw the gap here from right here. We can draw from the previous wick right here to the other previous wick, which stops right here. So this right here is going to be a fair value gap right here. This is a fair value gap, okay? As you can see, the 2 wicks, the gap starts and ends where the 2 wicks are on the outside, and then the inner candle is the body of the gap. So what does this gap mean? Well, that means when we come back and price comes out during this gap, we either fully fill the gap or we reject the gap. Those are the main 2 outcomes of gaps. So the gap outcomes are either fully fill it or we reject it. Or we sometimes even partially fill and then later on fully fill. This will depend on how big of a gap this is, okay? What time frame the gap is on. And last but not least, these gaps, when it fully fills or rejects, of course, obviously if it rejects, it goes in the other direction. Once it fully fills, typically these gaps will reverse as well. So what happens here is, as you guys can see, the gap is either going to reverse or fully get filled. Actually, so let's give it a reverse. Okay, so this is telling me that as price is moving, as price is moving along, we see this gap, we identify this fair value gap. We are looking for price to fill this gap or reject this gap. If price rejects this gap like this, as you can see, this gap is utilized as a rejection gap. That's what I call it, and that's when we can play longs or calls off of this rejection right here, off the gap. Because we know there's a gap here and it rejected off the gap, so we can play this long right here, pushing up, because we also know we are touching into demand. The second scenario is we fully fill the gap. Now, in this situation, we don't fully fill the gap. And the reason why is because, again, it depends on how big of a gap this is. This is an extremely big gap, okay? Each asset has different size gaps. You want to be careful with that, but this is an extremely big gap, and this is literally on the hourly time frame. If you scroll down to the 30-minute, this gap actually ends here on the 30-minute, okay? If you go on the 5-minute, actually, you'll see these gaps are not as big. These gaps are even smaller. This gap right here is actually only from here to here. Okay, there's no really gaps here. There's a tiny gap right here. As you can see right here, there's tiny gap between these two candles that price perfectly filled. So as you can see, basically the higher time frame the gap, that means the longer it's going to take for the gap to fill. The hourly gap, which is this size right here, is going to take a lot longer to fill than these smaller gaps within these big gaps, okay? So you can use these as a multi-layer confluence if you want. Me personally, I only look for gaps off the 5-minute time frame. They work the best for me when it comes to getting precise entries like this and then getting good risk reward trades with a high win rate. These bigger gaps tend to take longer to fill. So I would avoid playing off 30-minute and 1-hour gaps. What I use 1 hour and 30-minute gaps is to identify where price most likely wants to go. Because we know price has to fill these gaps. No matter what, even if it rejects the first time, price at some point has to fill the entire gap. That's the rule of the market. That's the nature of how price is. Price has to fill every single price, every single order. So this gap, we know at some point, price can do whatever it wants here, but I know for a fact at some point, price will reject here and it has to fill this entire gap. And what it wants to do after it fills the gap is up to price, okay? But we know for a fact it will fill that gap. So if we play this out, look at what happens here. We filled the gap. We literally filled the gap. And then fully we filled the 1 hour gap. So I can see this was a 30-minute gap we filled first before we filled the 1 hour gap. So which one recognize is these higher timing gaps roughly tell us where price will potentially hit, and they could be longer term targets. So big gaps on higher time frames tell me where price is roughly going to go towards. These smaller gaps are where we're going to be using as our entries. Okay, so the 5-minute gaps are going to be what we're going to be using as our entries. Again, there are two ways you can enter in terms of zones. You can either enter off supply demand zone on the lower time frame, or on the lower time frame, if you find a gap, you can enter off that gap for more precise entries. So those are two ways that you can utilize these as entry points. Now, for these gaps, you want to understand no one knows at when this gap was going to get filled in a higher time frame. We don't know when the gap is going to get filled. What we do know is eventually it will get filled. So the question obviously is when it will get filled is just a matter of time, right? That means when I'm in this trade, let's say I'm in shorts here, I know for a fact, I'm aware there's a 30-minute gap below us. That means I really want to hold this trade longer. I would love to target this gap to get filled. Straight up, that's how it works. So once we get into supply, with enough momentum, I know for a fact we will have to fill this gap at some point. So it could more likely happen off this trade right here, because the first time we rejected the gap, we partially filled the gap. Now we need to fill the entire gap. So that's basically how it is. And again, even on the 5-minute, there are times where 5-minute price just rejects the gap. So where you want to enter within the gap is obviously completely up to you. Same with zones. Do you want to enter right when price touches the zone, or when price fully fills the zone? Same with gaps. Do you want to wait until price rejects and touches the zone, or do you want to wait until price fully fills the gap for a better entry and safer entry, but missing out on a potential move if it does not fill the gap? There's two things, two conflicts. It is all up to you and your personal preference. You can backtest all of this on all your assets that you plan on trading, is my best personal opinion. You want to backtest all of this stuff so you can get a general feel of what you prefer, because trading is all based on you. The market is a reflection of who you are as a person. You want to adapt your personality to the market. Okay, so now that we recognize that, one last thing about these fair value gaps I want to talk about is time. So as we know, how time works is the 1 minute always comes before the 5 minutes. The 5-minute always comes before the 30-minute time frame. The 30-minute time frame always comes before the 1 hour time frame. The 1 hour time frame always comes from 4 hour and daily and weekly. Okay, this is a sequence in time frame. Now, what people don't understand again in time frame is obviously because the higher the time frame, the longer it's going to take to fill the gap. The gap is not certain when it's going to get filled. Now, these small little incremental moves that are filling these gaps slowly and steady are signs that this gap is going to get filled. The moves always start off the 1 minute time frame. The 1 minute time frame is the earliest to the move. As the 1 minute time frame develops, that then develops the 5 minute time frame. Once the 5 minute time frame develops, then that develops the 30 minute time frame, and then the 1 hour, and then 4 hour, daily, and weekly. So that's how you want to think of these higher time frames and lower time frames. They are like a sequence to a story, okay? The lower time frame is going to develop price action before the higher time frames, but the higher time frame is going to tell us where price at some point on a higher time frame and longer time is going to reach. So knowing that logic and understanding that, we will understand what gaps to use on what higher time frames and what time frames we should be utilizing based on our trading style. Now, of course, fair value gaps take time to practice, to identify. So I would highly recommend you guys continue practicing and learning how to identify these gaps. For example, I found another gap right here. 2 wicks on both sides are necessary, and we need to have a big, strong pulse and move. And the wicks are not overlapping. They don't have to overlap. The wicks just have to touch each other. They're not on both sides, so that's a gap. Let's try to work on finding gaps again. Another gap right here. This is the hourly gap. Okay, wicks are not touching each other. We have 3 candles and we have a big move. There's a gap, and look what happens. At some point later on, we fill the gap. The first few times we actually rejected the gap twice, and I bet you for a fact there are other gaps within this gap. Let's see how, depending on how big and fast this move is, we'll see. But I'm almost certain there must be more gaps within this gap. Okay, I guess not. This is one of those situations where I guess it was, geez, this is a 5 minute move right here. News must have came out or something that pushes market. So that's a 5 minute candle right there, which is absurd. But point is, yep, there's the gap rejected twice, as you guys can see. So if you're someone that's a passive trader, you would wait for the gap to fully get filled. But don't forget, we have a thing called retracement that occurs, right? We are in a ranging market. We are retracing, meaning when this gap gets filled, don't try to expect to play the rejection right away once it gets filled to the upside. We know we still have retracement left, so you want to put in together all these market clues to tell you where price is eventually going to lead up to. Again, this is stuff that comes with time and market experience. I can't just sit here and tell you this is how you read price action, things like that. You have to practice, and this will come with experience naturally and identify. So in this situation, you can clearly tell price has decided to take the full retracement down. So we would obviously not be playing any demand or rejection of this gap. We would just be playing it up here and holding it to fill the gap. So there's gap fill plays and there's gap rejection plays. Those are the 2 main plays that you'll be looking at for gaps. Now let's go in the lower time frame. All right. Now I'm going to show you guys how you can utilize 5 minute gaps to enter trades. Immediately, boom, I can easily spot these gaps all the time. 3 candles, big impulsive move, and wicks on both sides. There we go. We have a gap right here. Fair value gap. It touched it, it rejected, and reversed. And obviously, I would not be playing this zone ever. I would not be playing this gap ever because I know higher timing is telling me this is coming back down. So no point in playing that little move. But let me show you guys or find some examples of where we can play these gaps on the higher time frame or lower time frame, similarly to zones for better entries, in fact. So what happens is my order of thinking when I'm looking for these zones or gaps is I first look for gaps, okay, with big moves. If I cannot find a gap with a big move, that's when I'll use a zone. This is a perfect example right here. Look at this. Usually you would draw a zone here, right? This would be your zone, okay? Well, what I notice here is we have a fair value gap right here. 3 candles, 1 candle, 2 candles, 3 candles. Look at the wicks on the first and third candle. They do not touch each other. They have this gap in between right here. This is the gap. Boom. And guess what price does? Price fills that gap and then continues going down. Basically what happened here is price pushed really fast down, leaving a gap, and price needs to fill this gap. And luckily this time, price decides to fill the gap quick. So price does a pullback into the gap to fill the gap and then push back down in this direction. Very simple. Now, of course, this may seem complicated at first, but as you practice this and understand gaps and how you utilize them with zones and all your other confluences, it becomes very easy. You can see gaps, yes, sometimes they wick out just a little bit. Again, this can also be due to the source of your broker and many other things like the source of your chart. So I would not put your stop loss like right at the gap. I'll put it a bit above the gap to be safe, because you don't want to get wicked out. And another thing is you want to take into consideration of spread. Okay, so brokers have spreads. No matter what broker you use, there's always going to be spread. No broker has zero spread at all. So you want to be careful and move your stop loss even a little bit more to give it a bit more room space in case you get faked out or wicked out and get stopped out. So there we go. We enter off this fair value gap instead of waiting for price to enter this zone right here. Now, yes, we still have this zone. This zone is still valid. We can definitely still play off this zone, as you guys can see. Again, wicking off a little bit off this zone. This is why you want to have your stop loss, again, a bit more higher if you're taking this aggressive entry off these zones. If you're taking a break of structure, your stop loss will not be that high. You see, the zone has worked extremely well. Every time price enters this area, dude, just you can leave short every single time until the zone breaks. Now, my general rule of thumb is after 3 touches, I don't play the zone, okay? So 1 touch, 2 touches, 3 touches. I would avoid playing this zone after 3 touches. Now, in this situation, the zone worked out very well. But on these small time frame zones, they typically don't last long before they get broken through. This zone only lasted 2 touches until it got broken through. So you want to be careful with that, right? Price can never stay within this range. Price at some point has to break out. That's why we like to use fresh new zones whenever we can. The thing with these higher time frame zones that taught you guys how to utilize is these higher time frame zones can hold for much longer touches, much more touches. You see the number of touches this zone has? 1, 2, 3, 4, 5, 6. We have 6 touches here within the zone before it breaks. So these high time frame zones hold a lot more value, hold a lot more strength, and are able to be played a lot more. So I don't have a number of touches for the high time frame zones. I play these high time frame zones until the bias or the zone disappears and breaks. That's it. Let's see if I can find another example of fair value gaps here. Okay, so again, my order of thinking is once I draw my high time frame zones, I look for 5-minute fair value gap. If there's no fair value gap, I draw a zone. Okay, it's that simple. We have a zone. We have a fair value gap right here. Boom. This is the magic, bro. I'm telling you, this works wonders. Look at this right here. Perfect trade. It filled the gap. It did not fill fully. If you have not noticed that, this gap did not get filled fully. But again, there are things that cause this, whether that is a visual glitch or a data glitch of the brokers and sources that you are utilizing. So this gap in essence could have been filled, but just didn't look like it on the chart. So you want to be careful and just understand that stuff like that happens. So I would enter here, stop loss below the gap, and we can target these previous highs, key levels, okay? Target these previous highs. Once we target these previous highs, we can target these previous highs. Once we target these previous highs, hits the moon. All right, 1 to 9, 1 to 10 trade right there off a fair value gap entry. This entry is more accurate than having a zone because the zone you'd be drawing over here and price would never touch your zone. You would miss out on an insanely great trade. That's a lot of pips right there. So that's why fair value gaps are very important. I like to play off fair value gaps before playing off the zones. Now, how can you identify valid and invalid fair value gaps? Well, first of all, you want to have fair value gaps on a solid time frame. 1 minute fair value gaps, most of them are very invalid. I don't play them. I only look for fair value gaps on the 5-minute time frame. 5-minute has worked best for me for fair value gaps. Again, you want to focus on time frames. You don't want to be switching around time frames too often. You want to focus and master a few time frames. That's what I highly recommend for beginners. Now, to identify these what are valid fair value gaps on a 5-minute and what are not? Well, I would say valid fair value gaps are fair value gaps that are created near a big impulsive move and near the start of a zone. So this here clearly is a demand zone. And clearly, this is a fair value gap. This fair value gap was created near this zone, making it very valid in high quality zone or high quality gap. Now, if we're looking for other gaps, there's gaps everywhere around the chart. Let's see. We have a gap right here. These 2 wicks never touch. And this candle, okay, look, you actually don't need technically 2 wicks on both candles. Sometimes you have candles like this where there's just no upside wick at all. The body's there. That means there's a gap right here. Okay. That would be the gap. And look what happens here. There's not really, it just got filled and nothing happened, okay? This gap just got filled. The reason why is, first of all, we need a strong move. This isn't an insanely strong move. Yes, this is still a solid move, but I would say look for gaps that are very, very strong is the best way to find valid gaps. So that was probably a bad example. Let's find a better example of a gap that's just bad. This is not a good fair value gap right here. Okay. This gap clearly did basically nothing. I mean, sure, there's rejections, but we're not trying to catch these tiny little moves. We're not going to get a good risk reward out of that. This gap is also created before a demand zone was even created, okay? And this gap is near the bottom of a move where there's no demand zone created. So you want to make sure that there is a zone created first, and then that zone creates a gap. You don't want it to be where this gap is created first, and then a zone appears. That doesn't make any sense, okay? So look for gaps near big impulsive moves is my recommendation. We're looking for these valid gaps. So let's see if we can find another example before I move on to the next video. Again, this is pretty basic stuff that, well, I wouldn't say basic, but stuff that once you master, it truly will change your trading. Here, let's see, we have no gap. Okay, we have a tiny gap right here. Again, we touched into it and filled it. So once we fill this gap, the gap becomes invalidated. I would be playing this zone instead because we already filled that gap. So right here, I'll be playing off of this right here. That would be an aggressive entry, but that'll be a zone play. And if you can find other gaps, that'll be great. But if not, it's all good. You can play off zones like usual. Here we go. Very fast. Again, it takes time and practice to identify these gaps quick, but once you do have the time and practice, you'll be able to identify them a lot faster. Look, we have a strong demand zone that was created first of all. We need the zone to be created first. Strong demand zone already created first. Then we created this fair value gap, which means it's an A+ excellent fair value gap. You can enter this with tight stop loss too. This is a small gap. This is why I love trading off fair value gaps that are valid, because they give you great risk reward trades like this, 1 to 10. Easy money right there, easy money. Now, when we don't have a gap, don't forget we can trade off the typical zones. Very simple. And again, stop losses, make sure don't get liquidated. So stop losses a bit more looser on zones. So that is basically the gist of fair value gaps and how you can utilize those to your trading activities. So that's essentially one of the two main things that I utilize, zones and gaps. I utilize many other factors and confluences when entering my trades, but that is one of the few things that do matter a lot when it comes to trading technically. So that's going to be it for this video, and I'll see you guys in the next lesson.